I want to bring in one of Wall Street's most well-known analysts. Joining me now with more is Dan Ives, Senior Equity Research Analyst at Wedbush Securities. Dan, it's great to have you on the show this morning. We will get into Tesla results last night, which I know you've been following. But I first want to ask about the NYSE-listed stock. Disney certainly has been in the spotlight the past week amid news of its CEO succession plan. What does this mean for the media company?
Look, I think it's potentially a transformational time. And with Iger, obviously giving back the reins with a new CEO coming in over, the next, call it 12 to 18 months, it's a pivotal time for Disney. I mean, in terms of where we are, in terms of from its properties, from the streaming, from a cost perspective. And I think it's a fork in the road, but I think it's potentially a positive fork in the road. I think that's sort of my view. A lot more could go right than wrong, given the positioning here.
Interesting. So we see former Morgan Stanley CEO James Gorman now elected to the board to steer the succession plan in the right direction. He had a lot of positive feedback, of course, with his succession plan at his former company, Morgan Stanley. How does that set Disney potentially up for success?
Look, you want to pilot on the plane that you feel comfortable sitting in 3A watching Netflix. And the point is, Gorman is someone that Street has confidence in. His record speaks for itself in terms of his career. And I think ultimately they're going to pick the right individual, whether it's internal or external. But the next decade at Disney will be defined by ultimately who is in that CEO seat. And I think when you look at some of the things they're doing on the ESPN side and some of the properties, I think there's definitely some shoots of growth, in terms of where things are. They definitely have headwinds, but Gorman, I think, is going to soft land this airplane.
So we had seen Disney recently up prices on its streaming service by $2 a piece. Consumers seem to be resilient, but with so much competition out there in the streaming space, do you think that will prevent churn and keep customers around?
Yeah, I think churn will still be pretty minimal. I mean, they've had some churn in the past. It's pretty stable. Obviously, a lot of that is content driven. But we've seen, look, Netflix has raised their prices. I mean, this is ultimately, as the price of content's gone up, it's what Disney needs to do. But they need to monitor churn because the golden goose for Disney is monetizing its install base, whether it's on parks, streaming, other properties. And I think that's something that investors want to see. And on the streaming side, then they made some big bets. But that's the right move, I think, to raise prices, just given especially the cost structure.
Mm-hmm. How crucial is streaming to Disney's business? Of course, it is a media and entertainment company, but has its hands in other verticals as well.
Look, I think you could look at it from a top line and be like, it's not as significant, of course, as the parks and some of the core properties. But I think from a stock perspective, it's significant because from a multiple, investors want to see where the growth is. Streaming, content, how could ultimately Disney create the other growth drivers in the future? And I think streaming and content is going to be one of those core paths. And that's why I think it's been the right move to almost double down on that strategy the last few years, despite obviously a lot of critics. But now you need a CEO. Maybe there's other assets that strategically, they sell or go away, but you need sort of the new path of growth for Disney over the next 5-10 years.
Look, I do want to turn to Tesla. That stock just continuing to climb since its better than expected report last night. Currently, shares up about 17%. We're looking at a market cap gain of more than $100 billion in just less than 24 hours. What was behind these results? Can this momentum in Tesla be sustained?
Yeah, I mean, look, I thought that was an Aaron Judge-like quarter. In terms of margins, that's really been the headwind here. In terms of the price cuts, and that's been a big overhang, and they crushed margins. I mean, beat by 200 bips. Looks like that trajectory is going stronger into next year. The delivery growth that Musk gave, I mean, 20 to 30% delivery growth for 2025. That's almost double, where the street was from a whisper growth perspective. I believe this. I mean, you've talked about this before. This is an inflection point time for Tesla. Huge step ahead in terms of what they delivered last night. And I believe it's get the popcorn out because as you get autonomous, AI, a lower price vehicle, a lot of growth drivers, and the bulls, music to the ears for the bulls this morning.
I want to talk about China because that is a key growth market for Tesla, for other tech companies set to report, like an Apple, for instance. What did we see play out in that market that was able to give Tesla the lift that it has today?
Yeah, I mean, China's the key part of the growth story this quarter. I mean, it was the best month, September, they've ever had, best quarter they've ever had. I do think what you're seeing in China, I mean, even our iPhone checks, and we'll see this from Apple next week, China actually looks strong for Apple. Clearly, a lot of issues that we're seeing in China, very choppy macro, but I believe there's spots that we're starting to see growth. And that's a positive, especially when it comes to Tesla, especially when it comes to Apple, because China's the hearts and lungs of these growth stories when it comes to Tesla and even when it comes to iPhone.
I've seen more and more Cybertrucks on the road here in Manhattan. It is a very large, futuristic vehicle, of course, for city life, Dan. But in terms of what we're seeing, the momentum behind the Cybertruck, and a headline that I saw yesterday that the Cybertruck actually achieved profitability. Do you think that is becoming core to Tesla's strategy ahead?
Look, it's a showcase car. I mean, it's one just like you said, if you see a Cybertruck pull up to a valet, little silence, right? And that's part of the cachet of Tesla and the brand they built. Now, in terms of the overall demand story, 2 million vehicles next year, Cybertruck's still a very small piece. But it does speak to, it's not just about Model 3. You got Y, you got what I believe Semi, you got Cybertruck. You're going to eventually have Cybercab in 2026. They're expanding the portfolio. And that's why, I believe, especially when it comes to AI autonomous, it's the most undervalued AI name in the market.
Interesting. Well, certainly more richly valued here in the past 24 hours or so. Again, a market cap just under $800 billion this morning. As of close yesterday, about $680 billion. We could talk about Tesla forever, Dan, but looking ahead to earnings season picking up, more technology companies on the docket to report. What else are you looking out for from tech companies this earnings season?
I think get the popcorn out. I think we are going to have a robust tech earnings season. I mean, AI, it's the biggest transformational growth theme we've seen in the last 40 years. Mag 7, especially when it comes to the big cloud players, Microsoft, Google, Amazon, I think are going to have robust numbers. I think Apple is going to be strong as well, especially going to the holiday season. And we have an election, so there's some volatility, but I think tech rips higher into year end because of the fundamental stories. In this AI revolution, it is still early days of playing out for the rest of tech.
All right, Dan Ives, Senior Equity Research Analyst at Wedbush Securities. Dan, always a pleasure. It's great to see you. Thank you.